Hello and welcome to The Inside Basis, Unleashing the Power of Tax, a podcast from global law firm K&L Gates. Each episode looks through the lens of tax law to examine current issues impacting business. We hope you enjoy the discussion. Please reach out to suggest topics or guests or with questions about tax law.
Hello and welcome to The Inside Basis, a tax podcast brought to you by K&L Gates. I'm your host, Randy Clark, and today we're going to talk about the One Big Beautiful Bill Act, the most significant piece of tax legislation Congress passed in 2025 so far. While this bill isn't specifically an M&A bill, its tax provisions are set to significantly influence how deals are structured, valued, and negotiated by both buyers and sellers. We're going to break down 6 core areas where the bill is reshaping M&A. So let's get started. The first one is the business interest expense deduction provision pursuant to Section 163J of the Code. This one is very significant, particularly for private equity firms and highly leveraged businesses. Before the bill, the deduction for business interest expense was generally capped at 30% of what we consider EBIT for tax purposes, or earnings before interest and taxes. This was a more restrictive calculation that came into effect in 2022 and didn't allow for the add back of depreciation and amortization expense, artificially deflating the interest deduction limitation. After the bill, for tax years starting December 31st, 2024, the calculation's been permanently restored to an EBITDA-based formula. So that's inclusive of taxes, depreciation, and amortization. This means that adding those back to adjusted taxable income before applying the 30% limit of 163J makes the deductible portion of interest expense much larger for many taxpayers. For buyers, this is a major win, particularly for private equity businesses and financial buyers who rely on leverage in their transactions as part of their investment model. This increased deductibility directly leads to additional cash flow in their projections from tax savings and may offer some deal financing flexibility. For strategics, including those that are backed by private equity, this change might improve cash flow and borrowing capacity. It makes deal modeling easier. It allows buyers to think about how much leverage a target company might support. For sellers, this can help enhance valuations. It can help sellers demonstrate higher adjusted earnings when you take into account these interest deductions and tax liability of a target business. It could also potentially fuel deal making, increase competitiveness by just making levered deals more attractive overall. Another major change relates to deductions for operations of business, both bonus depreciation and what's called Section 179 expensing. These provisions are now made permanent and significantly enhanced. So under prior law, prior to the bill, bonus depreciation was set to phase out, reaching a pretty low percentage in 2025, just 40%. The Section 179 expensing cap, the ability to write off certain investments, was also capped at $1.25 million with a phase out. So the bill has permanently restored 100% bonus depreciation for qualified property, allowing for the immediate expensing of most depreciable tangible property and certain intangible property as well. Vehicles, furniture, heavy equipment, and similar. 179 expensing is also doubling, increasing the deduction cap to $2.5 million and the phase-out threshold to $4 million. For buyers, while they generally do already have an incentive to structure transactions as an asset deal or an asset-like deal for tax purposes, for liability reasons, there was always a tax benefit to doing so because of new depreciation and amortization. However, this accelerated depreciation allows even better post-acquisition cash flows in early years, better upfront tax liability, and potentially a higher after-tax return on investments. So in competitive scenarios, these benefits might even offer justifying a higher purchase price. On the sell side, these changes can make businesses with these types of qualifying assets even more attractive to buyers and potentially increase their sales price. There is a flip side to this, though, in that the faster that depreciation occurs, or is permitted to occur, the more likely a seller participating in an asset deal is subject to what's called depreciation recapture, which is when you sell a depreciated asset at a gain, a portion of that gain can be recharacterized as ordinary income to the extent attributable to those prior depreciation deductions taken. That depreciation recapture can increase a seller's tax liability, making this a pretty critical point in M&A deal negotiation because the buyer wants to potentially maximize value to these types of assets, and sellers have a significant incentive to limit them to avoid that ordinary income. Certainly, though, what the bill does is it pushes farther in favor of asset-like deals because of these increased benefits. Another major change for companies that are constantly innovating and researching is the impact of expensing of R&E costs. So the Tax Cuts and Jobs Act, 2017's tax reform, originally would have provided that for domestic research and development expenses after 2022, such expenses were generally required to be capitalized and amortized over 5 years. This can result in a pretty meaningful tax drag on cash flow for some innovation-heavy businesses because those weren't generating immediate deductions. Those deductions were effectively pushed out. The bill has reversed this, permanently restoring full immediate expensing of domestic research and experimentation costs incurred after 2024. Foreign R&D expending, though, is still subject to amortization. Additionally, certain small businesses can apply the immediate expensing change retroactively. For buyers, this is another cash flow impact. It directly impacts after-tax earning, directly impacts cash flow for research and experimentation heavy businesses. This is businesses like biotech, technology, manufacturing, engineering, design. All of these make innovation-driven companies potentially more attractive acquisition targets, and their higher free cash flow can potentially lead to higher valuations in these sectors as well. From a seller's perspective, this of course reduces the drag on valuation that you might see from increased cash flow that just goes towards taxes. Another big thing that might help sellers here is additional impacts on valuation from the availability of free cash flow. You put all these factors together, increased expensing, more available leverage, and some of these innovation-heavy companies are now going to have more free cash flow available, saving tax to increase valuations in these high-tech type of innovative areas. A very significant change in the middle market are expansions of the qualified small business stock eligibility rules under Section 1202. These were significantly boosted. Historically, the QSBS rules allowed for 100% exclusion of capital gains from the sale of qualifying C corporation stock. One of the major requirements that was that such stock had to be acquired at an original issue, which rule hasn't changed, and had to be held for at least 5 years. Two other meaningful requirements in the qualified small business stock rules that are impacted by the bill. Historically, there was originally a per issuer exclusion of $10 million, subject to some adjustments depending on what the holder's investment was, but a per issuer exclusion of $10 million. Another issuer-based limitation in the QSBS rules relates to the size of a qualified small business. Very generally, the QSBS rules historically required gross assets, which is a specific measurement for QSBS purposes, but required gross assets of no more than 50 million. Now, gross assets for this purpose very generally means the tax basis in an issuer's assets. But in certain circumstances, particularly contributions of assets that were made to that issuer, assets have to be valued at their fair market value. So the $50 million threshold is generally analyzed by the market kind of just by looking at a balance sheet, but there are some nuances to that have to be taken into account. Some of them, however, were made more easy by the bill. The first major change that the bill made was for QSBS issued on or after July 5th, 2025. And what that does is it provides a tiered exclusion to the operation of QSBS rather than the flat 5-year on-off switch that we used to see. That tiered exclusion works as follows. So for shares that are held for at least 3 years, 50% of the gain on those shares is excluded from income. For shares that are held for over 4 years, 75% of that gain is excluded from income. And for shares that are held for over 5 years, the historical 100% exclusion is still in effect. This is very meaningful because it offers flexibility for earlier exits. Another change that the bill made is the per issuer gain exclusion cap. I mentioned $10 million before. It's now increased to $15 million, and it's indexed for inflation. Third, I mentioned that corporate level gross asset threshold for qualification was historically $50 million. It's now been raised to $75 million and also adjusted for inflation. For sellers, these changes can mean very real tax savings for startup businesses and for qualifying sellers. That was always the case for QSBS that was held for 5 years. But the new tiering approach might offer more flexibility for timing of exits. We'd often see instances where a seller was faced with a great transaction for a potential QSBS eligible target. But if that price, if that great deal showed up 4 years into their holding period, sellers were faced with a pretty tough choice of, do you take a great deal now and pay 100% of the expected capital gains tax that you would have paid? Or can you hold out for 1 year and potentially get another corporate stock deal that might offer no tax? Comparing those after-tax returns is really difficult because you don't know what's going to happen in the future. But with this 3, 4, and 5-year tiering, there's a lot more flexibility offered to sellers. For buyers, these changes meaningfully increase not the types, but the number of companies that might be eligible for a QSBS-based transaction structure. That increase to 75 million gross asset threshold is a 50% increase. It can also make rollover potentially more attractive if a buyer is setting up a QSBS eligible structure where the seller wasn't originally eligible for QSBS benefits. So knowledgeable, well-advised sponsors can design a structure that a seller might be able to roll into and get QSBS benefits going forward, making that second bite at the apple that's so important in sponsor-based transactions, making that even more efficient on an after-tax basis if it's QSBS eligible. Another change that the bill made is changes to the qualified business income deduction under Section 199A of the code, particular major benefit for pass-through entity owners. So before the bill, there was a 20% QBI deductions for non-corporate taxpayers introduced in the Tax Cuts and Jobs Act, but it was temporary and it was scheduled to expire after 2025. This created a lot of meaningful uncertainty, particularly for entity choice type of planning where you're considering operating through a partnership or S corporation or a C corporation. The bill does make the QBI deduction permanent at its current rate. It should put pass-through choices in reasonable parity with corporate choices without necessarily rewarding one over the other. For sellers, this allows some more long-term certainty when you're thinking about designing your business, how you're going to operate it. But it can also help reduce the overall tax burden on pass-through sellers that engage in asset transactions, because that asset sale gain may be eligible for the QBI deduction. For buyers, anytime a seller potentially has a lower tax burden on a transaction, there's always going to be smoother negotiations. You're always going to have better harmony in working towards a transaction structure that results in a positive result for both parties. Now, a very heavily discussed topic, but less impactful in its actual results from the bill, are the state and local tax deduction cap and various changes around the pass-through entity tax election rules that were discussed in earlier versions of the bill. So these play a critical role for transactions for sellers in high tax states. So historically, there was no state and local tax deduction limitation. But following the Tax Cuts and Jobs Act, individual itemized deduction taxpayers did face a $10,000 cap on their SALT deductions. Many high tax states implemented what's called a pass-through entity tax system that provided some workaround for this to allow individual taxes to be paid at the entity level, resulting in a business deduction that was generally not limited by that SALT cap and could be allocated out to the individual members. So the bill makes some notable changes to the SALT cap and makes some non-changes to it, I'll say. The SALT cap is temporarily raised to $40,000 for individuals for tax years 2025 through 2029, although it does phase out very generally for taxpayers with an adjusted gross income over $500,000. In 2029, it will revert back to 10,000. So there's a small window where federal tax liability in these transactions can be reduced by more state and local tax deductions. But because the pass-through entity tax systems that these states have implemented were generally untouched by the bill, the pass-through entity tax selection remains a valuable tool for thinking about state-level tax exposure in transactions. In some instances, it might allow sellers to achieve a higher after-tax return in an asset sale than they would in a stock sale if it can convert what would have otherwise been non-deductible state and local income taxes on the stock transaction into deductible business expenses in the asset transaction. And again, for buyers, a major benefit of anything that increases seller efficiency is deal harmony, deal negotiation, and strategy. Where buyers are pursuing asset deals or asset-like deals, anything that can make that more efficient for a seller is a major benefit to deals. So, in summary, while the bill wasn't explicitly an M&A bill, it does provide a meaningful new set of rules to take into account that I think can really impact deal valuations. It can make asset deals potentially more favorable to sellers, so creating a more buyer-friendly environment for the transactions that they like to see. And the QSBS benefits offer a lot of planning opportunities in addition to the permanence of the 199A deduction for qualified business income. Now, these are opportunities, but they also bring their own complexities, so require careful navigation. Whether you're thinking about an asset-heavy target from a buyer perspective, whether you're thinking about planning your R&D spending, or you're a seller looking for a tax-efficient exit. I mean, the most important thing to take into account is your tax structuring early, take into account your transaction goals early, think about valuation, think about future operations, and work with your advisors to optimize your financial outcome. That's all for today's episode of The Inside Basis. We appreciate you listening and look forward to talking to you again.
Thank you for listening to this episode of The Inside Basis, Unleashing the Power of Tax. To listen to past episodes and receive notices for new episodes, subscribe by searching Hub Talks. That's HUB Talks in your favorite podcast app. Tune in next time for more tax insights.